it might be better to buy under a company now, not trust, maybe not individual names. They'll be chasing higher yields for sure because they don't have that tax offset. They want to save a $15 monthly fee and just park all the money in the redraw. But they're shot themselves in the foot now. Yes, you might have the growth, but you've got a lot of cash burden. You've got the rental income. Don't forget, you're getting taxed on that now because they can't borrow as much. They might not be able to bid as high. That means the owner-occupiers have kind of a better chance. Banks love it. Developers need to make money. That's great for them because you're much more stickier to that bank.
Welcome to Cashflow Curiosity Podcast, where we share advice from experts on how to improve your cash flow and hopefully get a much better yield for your investment properties. So today, I am your host, Keith Chen, and I've got Simon Tran from Finer Advisory. Thank you for coming, Simon.
Thank you for having me.
Awesome. So in 60 seconds, could you tell us what you do and what is the biggest problem that you solve for your clients?
Well, firstly, I'm a senior mortgage broker at Finer Advisory. I'm also accredited as a qualified property investment advisor. So I've been in the finance and property industry for over 10 years. Most of my time, or pretty much all my time, was with Commonwealth Bank of Australia, CBA, mainly in the private banking division, so helping high net worth individuals predominantly. Now, what I do is I focus on providing tailored finance solutions to clients instead of trying to find them the cheapest mortgage. Yeah. Now, the number one biggest problem I feel and experience with clients is that they don't have a particular strategy or plan. So this is the part I focus on the most and spend the most of my time with.
Awesome. Thank you. With the recent May budget that was just released, there's tax reform announcements around property. So what do you think investors should do next about the information?
Yeah, so there's a lot to unpack through the May federal budget. Now, I would recommend people not to make any rash or impulsive decisions. It's right now, it's just the announcement, right? It still hasn't been legislated and it needs to pass through the parliament. Now, the devil lies in the details, right? So until we know exactly with all the details outlined, then we can make a call and decide on what to do next, right? So, for example, I'll give you an example here. So the government mentioned that if you hold a property before the May budget announcement, then you'll be subject to the previous negative gearing ruling, right? So what happens when you own a family home and then at some point in the future it becomes an investment property? Do you still get the negative gearing benefits or not? Yeah. So this is something we're not sure. Accountants are not sure as well until we see the finer details when it gets released. Yeah. So that's one of them. Another thing I would be thinking of if I was a property investor is I would be looking at reviewing my income and expenses from my current properties. You know, especially when it comes to rent reviews, and that's really important now. Now you got to factor in that you don't have that immediate, tax offset, meaning more money in your account at every single tax return time. So I'll be looking at that and making sure it is at truly market rent. Number two is I also look at, okay, what other methods can I do to increase my cash flow? Number one would be granny flats, but then also you need to factor in, am I taking additional finance for that, or am I pitching my own cash in? The next one is I might look at maybe value add play, which is duplex, knock down, build two duplexes, or subdivision. Another one would be room by room rentals, which is obviously helps with the cash flow side of things.
Yeah. Are those like rooming houses?
So yeah, rooming houses, boarding houses is a little bit different. It's subject to different ruling, but yeah, room by room rentals, obviously to improve the cash flow. And then the next thing I'll be looking at is cost reduction measures. So reviewing my interest rates through your mortgage broker or reviewing my property management cost. I'll be shopping around. Insurance costs, I'll be looking at that more carefully now. So really what I'll be looking at is how to improve my return on my investment if I didn't have negative gearing anymore. Yeah. Right. So another thing I'll be also be doing is I'll be speaking to accountants. If I was a new property investor, so I don't have that quarantine negative gearing benefit applied, then I'll be speaking to my accountant about what type of structure in terms of ownership that I should be buying under. Because different structures will have different outcomes in terms of tax and also leveraging. Don't forget that losses incurred by your residential properties, yes, you might not offset your current salary, but it can offset other profits from other residential properties. So if you've got maybe another property that's positive cash flow, well, you can offset that. Okay, so it's ring fenced against residential properties only, and then also if that's not the case, then you don't have any positive cash flow assets, then you can offset future capital gains. So it's not like it disappears in terms of the tax offset, it's just delayed potentially.
With the government making changes to negative gearing, would that mean that more people or more investors would be looking at positive cash flow as a main strategy when they are looking to invest in properties?
Yeah, definitely. So they'll be chasing higher yields for sure, because they don't have that tax offset, meaning less money into their bank account. So they'll be looking at more high yielding asset classes. It could be commercial, it could be doing room by room rental, it could be, as I mentioned before, building a granny flat and earning additional rent through that method. So yeah, it's going to be more focused on positive cash flow assets, or it might be negative right now, but they'll be aiming to get it to a positive cash flow at a shorter period of time, sooner rather than later.
Yeah, because I think otherwise it's going to be it wouldn't be as worthwhile for investors to be investing in property at the moment. So in general, but okay. When you sit down with property investors, what's the most common mistakes that you see them making?
Yeah, the common mistake is that they generally max out their borrowing capacity to buy that family home, and then they come see me for additional lending for property investment. Now, that is quite hard to do, because obviously they've maxed out their borrowing capacity already. So then the only option is, can we explore maybe second tier or third tier of non-bank lenders space? But ideally, what you should be doing is first speak to an investment savvy mortgage broker first before you even buy that family home. Understand your maximum borrowing capacity, and then work out what are the strategies and ways that we can preserve your borrowing capacity, right? Do we maybe allocate 70% or 60% of your borrowing capacity for that family home, and then allocate the remaining 30% or 40% to an entity? Right? So that's what I will be doing if someone come to me, be like, we'll work on how do we preserve some of that borrowing capacity to help you build your asset base and hold them for a longer period of time, because that's what property investment is. The goal is to always hold a larger asset base and hold it for a longer period of time. Now, the one thing I also want to mention is that people always think that they're buying their dream family home, being the first property. But that's never the case, right? People's incomes increases, especially for medicos, business owners, or anyone else. When the income increases, they generally want to upgrade their home or move into a better location. So I wouldn't be so fixated on the first property being that dream home. I'll see it as more as a stepping stone for either, yes, in the future, maybe upgrade your family home, or looking at as, yes, I've got my property that I can call home for now, but I'm also accumulating other investment assets, whether it's shares or properties, to then later on sell down to then buy that family home, or just not sell at all and just reap the returns through income or capital gains. Okay. Another thing I thought I would mention is that the ownership sometimes is wrong. A lot of people just make impulse decisions, spontaneous decisions, and just buy under their individual names. They might buy a positive cash flow under the highest income earner. That's why I think it's best to consult with an accountant, because now these days with all the tax reform changes, it might be better to buy under a company now, not trust, maybe not individual names, because land tax is similar to the land tax calculation is very similar to the individuals, right? So there's no surcharge like what trusts. If you were to buy under a trust, there will be surcharge that applies, but companies there's no surcharge, and it's the same land tax rate.
Yeah.
Okay.
Yeah.
So you got that land tax free threshold. I'll give you an example, right? So New South Wales has a land tax free threshold of around 1,075,000. That's applicable for individuals ownerships as well as company ownerships, right? So if land tax is a problem for you and you don't want to pay so much land tax, then I'll be looking at buying, let's just say in New South Wales, I'll be buying a property in my individual name and as well as buying another property in a company name, right? So that you've got two separate land tax free thresholds. Right. Again, cross-check this with the accountant. I'm not giving obviously any tax advice here, but that's my understanding and that's my own personal opinion.
Yep.
And the last thing is obviously using redraw instead of offset accounts. That's a common mistake that I often see.
Yep. What do you mean by that? Like, because offset accounts seems to be everywhere. We've got an offset as well. All my friends got offset accounts, but are they actually worth it for investment properties, or is it more nuanced than that?
Yeah, there's definitely worth it for offset accounts. Now, I'll tell you the reasons why. Now, redraw kind of works the same way as offset accounts. However, the biggest difference is you don't have full control over your funds. So if you have money sitting in the loan redraw, over time, the bank starts to erode that redraw balance. And that's because it wants to make sure that by the end of that contracted loan term period, you've paid off the loan completely. So people don't realize this, but you might notice that as the years go past, that redraw balance actually reduces. Whereas offset account, you have full control because it's a separate account, and you take money out, put money in. It's full flexible, right? Another thing is obviously the tax side that needs to be considered. So a lot of people, and I've got an example of this. A lot of people might think, oh, okay, well, I'll park money in the loan redraw facility, and because I have access to it, I could take the money out and use it for, whatever the purpose is, maybe so to buy a car or a holiday. Well, that now becomes non-tax deductible because it's now for personal use. However, if the money is sitting in the offset account and you take money to go on a holiday or buy a car, whatever it is that you want to use personally, well, it's still tax deductible because it's not affecting the loan balance. Yeah. Okay? So taking money to the redraw, it actually increases the loan amount. Yeah. So in the eyes of the tax man, they'll say, okay, well, the loan was at this level and then suddenly it's increased to this level. So what was the purpose now? So that's the biggest difference, right? Yeah. So I always recommend offset account, and that would apply for investment, mainly for investment loans and investment properties, but also even for the home, right? Because if you ever had a thought of this home becoming an investment property, and you've been aggressively paying down that home loan and the money sitting in the redraw, well then if ever in the future that property becomes an investment property, well, you kind of shot yourself in the foot there, right? You've actually reduced your tax deductibility in the future because you've really reduced the loan down.
There's not much to pay left, and be able to claim that as a tax deduction.
Correct. And people might just ask, oh, why don't we just increase the loan amount? I'm like, well, what's the purpose now? Yeah. So it's a common mistake, and I've got a live example of someone that had this or have had this situation where they just want to save fees on offset accounts. They want to save a $15 monthly fee and don't want to pay any sort of package fee, so they were happy to just go get a home loan, an investment loan, and just park all the money in the redraw. But they shot themselves in the foot now. They're like, now I can't claim anything because it's now basically it's almost fully offset. So then if you were to take money out, then it'll be the question will be, what's the purpose, right? So how I did it, when I looked at it, obviously I didn't do the initial finance, but now they came to me and they have the desire of buying an investment property. So what we're going to do is we are going to refinance from that particular lender to a new lender. But what we're going to do is we're just going to extract. He's going to close off. Basically, we're going to close. We decided to close off the facilities because there's no point. It's already pretty much paid off.
Yep.
So what we do is extract the equity out from the existing properties, and that money will be used to buy investment property. Right now, before the May budget, it would have been fully tax deductible. Now, it might not be. Well, no, it's not going to be, right? But the key is he's got other assets that are positive cash flow, so he's offsetting that. Okay, so he's got some sort of benefit by doing this. Not no benefit, because right now he's on a high income.
Yeah, but that's because he's got the extra overflow income from his other positive cash flow.
Correct. So that's and that allows you to obviously offset that.
Yeah.
And then if there's any excess, it will be carried forward to a future capital gains event when he does sell a residential property.
Yeah.
Okay.
Wow, that was a lot to talk about. I mean, I still have so many questions, but maybe we can bring you back another time for offsets, and also different situations for different stage of life as well. Because I'm just thinking, like, I've got lots of friends who are either just starting to look at buy their first home, whether or not, like you said, you're like, is it going to be an investment property in the future? Because you have to think about, well, like, this is not going to be my dream home, forever home, because it's only for my current life situation, life stage right now. Right. So, I mean, we'll probably bring you back another time to talk about that. Like, there's also questions like rent vesting as well. Like, is that also, worth talking about?
Yeah, exactly right.
But another question that, like, a lot of people ask me, and it's a really good question to ask, is the interest only versus principal interest repayment debate. It's something that investors argue about constantly, right? So how do you think about which one would actually protect cash flow, and does the answer change depending on where someone is in their, where they're at in their investment journey?
Yeah, so definitely. So it really depends on where they're at with this property journey side of things. So how I define these three stages in property investment is accumulation. Okay, that's when you're accumulating as many properties as possible. And then optimization is how do you improve the return on your investment, value add play, maybe improving the rental side of things. And then there's a consolidation phase, which is generally when you're transitioning to retirement. So generally, I would recommend is interest only repayment for accumulation phase because it takes the stress out of your cash flow position, right? Because if you're paying principal and interest across everything, the monthly repayments is quite large, right? So we try to go interest only so that it protects a bit of your cash flow so that you're not just owning one asset, you're maybe owning 2, 3 because you can manage that cash flow more effectively. Now, with this May budget, that might change a little bit of things. If you have investment properties now, obviously that's been grandfathered in terms of the negative gearing policy. So I would strongly recommend preserving that tax deductibility by either keep extending that interest only period because you do not want to start paying that down, especially if you're in the accumulation or in that optimization stage of your property investment journey. Yeah? When it comes down to when do you start paying principal and interest on your investment loans? Well, that generally happens after you've kind of paid off your home loan. Okay, so you've wiped out or paid out your non-deductible home loan. Then you look at, okay, well, which loan is actually earning or charging me the highest interest rate? And then are we focusing on paying that loan down? Okay. Now, whether you put money in the offset account or just opt in for principal and interest repayments, look, it really depends on where you're at. So when you're closer to retirement, I would strongly recommend start paying principal and interest down or accumulate as much balance in the offset account so that at the point where you do retire, that you're not paying any interest, you're purely just paying principal at that point of time. Does that make sense? Yeah.
But for someone with their first property, let's say that they're living in as well, right? Should they be paying P&I or just
Interest or interest.
interest only?
For the first, like the home that
Yeah.
they're living in.
Yep.
Yeah, I would recommend just paying principal and interest, but don't make extra repayments to the loan. Any extra money that you have aside will be parked in an offset account linked to the home loan, because you do want that flexibility, because you just never know whether that home will become an investment at some point.
Yep. What if it's their first investment property? So let's say they're rent vesting, for example. So that first investment property that they are renting out whilst renting somewhere else, should that be a P&I or just interest only?
For the let me just re-clarify that. So you're renting somewhere else, and then you're buying an investment property, right?
Yep.
It might change now because of the May budget. That's threw it off. I don't.
Yep.
Now I feel that rent vesting is going to be pretty hard to do,
Yep.
because your rent that you're paying is going to increase year on year.
Yep.
Okay, and you are buying an investment property. Yes, you're getting rent, but the beauty of rent vesting before the May budget was that you got the tax deduction.
Yep.
Now that tax deduction is no longer applicable anymore. Then it's just net. It doesn't achieve the outcome that rent vesting is made for.
Yep.
Right? Yes, you might have the growth, but you've got a lot of cash burden, meaning the cash flow outlay, because you don't have that tax benefit. You've got the rental income, but then you also, don't forget, you're getting taxed on that now as well. You don't get a tax offset.
Yep.
So on that point, whether to go principal and interest repayments or interest only, it's a tricky one now. I would still go interest only, but only with the view of going to buy another investment property.
Yep.
Okay. If it's just one investment property that you want, then I would think about maybe paying principal and interest repayments.
Especially if maybe they want to move into that property.
That's also a good point. Yeah. So if they're buying investment property with maybe a future lens of moving into that property, then principal and interest might make sense. And you got, obviously there's cheaper rates for paying principal and interest versus interest only. So it really depends. It's back then, before the May budget, I would have said for sure interest only. Now, kind of watch your space, kind of thing.
Yep. Yep. So, like you said, depending on which stage they're at as well, which in terms of their investment journey. So if they're accumulation stage, then pre-budget, it would have been definitely sounds like leaning towards interest only. But now because the budget depends on what is finalized, right?
Correct.
What comes out of from the legislation. Okay. Are there mortgage structures or properties that look great on paper for cash flow, but actually create problems down the track? Things investors don't realize until it's too late.
Yeah, so I often see cross-securitization or cross-collateralization of properties and loans. What does that actually mean, right? Yeah. So it means that you might have 2 loans and you have 2 properties that are used as security for both those 2 loans. Why I see this happening is because a lot of people think that, okay, well, my LVR is lower, meaning that I get cheaper rates, which is true. But the problem is, if you ever were to sell one of those properties, then you will require servicing tests at that time. So meaning that you need to provide your income, or it's basically an application to sell a property. Whereas if you were to have a loan and one security and you're selling that property and that property wipes out that loan, then they don't care about your income.
Yeah.
Okay, that's one. Number 2 is you don't have flexibility. So if you're cross-securitization or cross-securitized, if one property goes up and one property goes down in value, well, that brings it all down.
Yeah.
Right? You borrow less because it's, does that make sense?
Yeah.
So
then your borrowing capacities.
It's more about your LVR gets pulled in. So you've got one that's growing in value, you want to take out equity from that property, but because the other one is dropping in value, then it kind of cancels each other out. You see what I mean?
Yep. And then you have less borrowing power if you want to invest in something else?
No, it's more that you can't extract enough equity out.
Yeah.
It's the equity play.
Okay.
That's the thing. So you might have an apartment, you might have a house, and the house is growing in value.
Yeah.
And the apartment dropped by $100,000, and the house is increased by $100,000. So it nets itself out.
So does that mean, like, using your example of two properties, if one of them if you're able to, let's say, improve the cash flow, then you're able to have a greater equity value to be able to extract out. Is that calculated?
It's more on the equity side. Cash flow is probably not as relevant. It's more, okay, we've got the income and you want to pull equity out for maybe buying another investment property or doing whatever you need to do.
Yep.
But you think that, my house has grown in value by $100,000. But then you've got another apartment there, for example. I'm just putting apartment as an example, and that's dropped by $100,000. So where is the equity coming from now? Because they're tied to each other.
Yep.
Okay. And then also, banks love it. So if you go to a bank, they say, yeah, we'll cross the securities together and you get a cheaper rate, because that's great for them because you're much more stickier to that bank.
Yep.
Especially when prices are volatile. That gets much more stickier if you're cross collateralizing each other. Another property class that to be mindful of and to pay attention to is short-term service apartments. So the likes of Mantra, Quest, etc. Look, major lenders generally don't like to lend against this type of asset, and if they do, it's going to be a lower loan-to-value ratio, or LVR, and it could hover around 50 to 70%. That's the loan-to-value ratio, but also the income gets shaded down, right? So you don't, normal standard residential income, they will take a 20% shading of the gross rental income, but with these short-term stays rental income, they take a 35% shading, or maybe a 30%. And that's because of the volatility side of things. It's short stay, so you don't know if the economy goes down. Maybe people are not renting these hotel rooms.
Is that mainly with like the service apartments, or is it the same with like Airbnbs as well?
Airbnbs,
like owner-host Airbnbs.
Yeah, so it's look, these service apartments are generally managed by the hotel. So, Mantra, Quest, whatever it is, you have less of a control. Whereas a place that you own as a holiday home and you do Airbnb, you have a bit more control over it. So the banks generally favour that a bit more. So that's it's a little bit different. Again, lenders, it all changes depending on the lenders. Right. So whoever lenders you speak with, it might have a different appetite on how they treat Airbnb income. So, but they're getting more favourable now. They used to be not so favourable, but now they are looking at, maybe they just need to look at the past 12 months. Maybe they'll look at the last 3 months, the lowest rent that you receive, and then annualise it if you haven't had a full year. But they will also take into effect the actual property expenses. Which could be higher as well.
Okay.
That's the one of them, and then the next one is probably new builds with rental guarantees. Like, this is something I just want to reiterate to all the listeners out there, right? With the government pushing for people to buy new builds and with the tax benefits, you can imagine all the property spruikers out there, promoting these development stocks that provide rental guarantees, tax benefits, depreciation benefits. Well, you got to think about it, right? Why is a developer providing guarantee in rent? Number one. Why are they offering incentives to purchasers or buyers? And one is, you got to be mindful that they generally would inflate the purchase price to give you these type of guarantees or incentives. Banks generally would value it lower because of these incentives, because you kind of artificially inflated the price. And another thing is, obviously, strata fees are going to continue going up. So you always want to think when it comes to property investment, yes, you might get the immediate tax benefit through negative gearing because it's a new build, but you got to think about who are you going to sell it to? What's the resale value of these new apartments? I'm just using new apartments as an example, because the second person that buys it off you won't have that tax benefit. So then the question is, would it affect the growth? I mean, will you get $2 return for that initial $1 that you put in? right? So that becomes very questionable. And just have a look at the apartment prices in Melbourne, right?
Yeah.
So
would that be the same with like duplexes or townhouses as well?
So these are a little bit different asset classes. They're a bit more favorable than apartments because you still have exposure to land, right? So, and people generally like a little bit of outdoor space, not just some windows that you can open or a balcony that you just walk out in. So it feels, so townhouses are looking good. Duplexes are looking pretty good. Just anything really that has a bit of courtyard and a bit of land.
Yeah.
So yeah, just something to be mindful, guys.
So it sounds like, some of these properties, if it sounds too good to be true, you might be overpaying up front, and then you might be, spending a couple of years trying to catch up on a lot of these payments, or they might come up and you go, okay, well, whatever those incentives are, they only help soften or provide some sort of cushion or some sort of short-term benefit, whereas long-term, there's a much more negative impact on cash flow after the benefits ended, right?
That's correct, yeah. That's correct. So rent will be adjusted to whatever the market rent is. And number two is that every new build, you're going to be paying a premium, mate. You're going to be paying a premium because the developers need to make money.
Yep.
And the nice shiny thing, people generally pay more for.
Yep.
As simple as that.
Yep. Awesome. So if an investor came to you tomorrow with 2 properties and a goal to keep acquiring, what conversation would you want to have with them first?
Yeah, so I'll firstly look at what their maximum borrowing capacity is as an individual versus in another entity structure. Okay. Then I would go, okay, well, what is the difference between buying under individual name versus buying under a company or a trust, right? I would also look at what are the other lending options. So, maybe we don't go the major banks. Maybe we need to go to a second tier or third tier that have a bit more favorable policies, or we might need to go to a non-bank, right? Non-banks generally, you have higher borrowing capacity. Yes, interest rate might be slightly higher, but you have access to more capital and they are a bit more flexible. They can do low doc or old doc for self-employed borrowers. So I'll be exploring all those finance options, and really it comes down to what the clients plans are. Yep. Is it to accumulate as much property as possible, or is it to get it to positive cash flow as soon as possible? It just really depends, right? Yep. So we need to understand that what the end goal is, reverse engineer it into present tense. Yep. And then work out, okay, well, what's the strategy to help you get there? Yep. Okay, in a quicker manner. If residential is completely maxed out, then we look at, okay, well, maybe buying under a self-managed super fund structure. Now, a self-managed super fund structure, there's no changes to that. The tax reforms doesn't mention anything about self-managed super fund or commercial properties. So self-managed super fund is another way if a client wants to continue building up their property portfolio. It basically doesn't take in consideration your personal financial position. All they look at is what you've been contributing into super, whether it's from the employer super guarantee contributions, which is 12% of your salary, or if you have, and if you make any voluntary contributions. Yep. And they also will factor in the rental income. Yep. Okay. So they don't need to look at your current liabilities. They don't need to look at your personal liabilities side of things. There are occasions where they might look at your overall financial position, but that's only if you don't have enough serviceability through the normal super guarantee contributions, voluntary contributions, as well as rent, then they might look at your overall position. If you have a servicing surplus from your personal side, then they can use that surplus as additional, they see it as additional contribution that you'll be making to the super. Yep. The next thing is obviously commercial property. Commercial property, and I love commercial property. I invest commercial property myself. Now, commercial property, the good thing about commercial property is that financing, there's a lot of ways to financing, first of all. The common one that people might know or might not know is obviously lease stock financing. Now, how does lease stock financing work is basically they don't look at your personal financial situation. They literally want an executed copy of the lease agreement, which includes the schedules and all the terms, and they will lend against that lease document. Okay? So they use a ratio, what they call as an interest cover ratio, and it's basically the net rental income, so net, so gross minus all the outgoings, or the
Expenses.
or the tenant might be like a net lease agreement. So if they pay 80 grand, that's 80 grand net, and the tenant pays all outgoings. So going back to the interest cover ratio, it's the net rental income divided by the interest expense for the year. The ratio that the major banks would generally accept is a 1.5 times multiplier. Okay, so if you have no more borrowing capacity on your individual name and you found a commercial property and you have a lease agreement, and it has to be tenanted. It can't be vacant in possession when you buy it. It has to be a tenant in place. You've got an executed copy of the lease. Then they'll look at, okay, well, can the net rent cover this our interest expense through the loan at a 1.5 times ratio? Okay. So it gets a bit more, that's one option of lease doc financing. And obviously, there's still full doc financing, which is obviously looking at everything as a whole. But lease doc financing is one of the most simplest ways to do it.
Yeah. I mean, as a business owner, like I've always wondered, how would you use your SMSF to, one, grow your wealth, but also something as common that a lot of business owners do. They invest like a commercial property with the SMSF, and then they rent it back to themselves. So maybe in the future I might bring you back on that to talk more, because that's something that I would love to learn more about, and it'll be I think it'll be really beneficial for property investors who are also business owners as well.
100%.
With the negative gearing removed from the latest budget, what is the impact on borrowing capacity for investors?
Yeah, so I did some calculations before I attended here. So let's give you an example. So a person on a single salary earning 100 grand is buying an investment property, let's call it $800,000, with a rental yield of 3.5%. That's around $28,000 in gross rental income. Now, with negative gearing, and assuming this person is living at home, so you're living at home and buying investment property, which is what I did when I first entered the property game. Well, the maximum borrowing capacity is $800,000 with negative gearing. Now, if I strip out negative gearing, then the borrowing capacity is $560,000. Now, that's a $240,000 drop in borrowing capacity. That's massive.
Yeah.
Right? And that's predominantly due to you don't have a tax offset, meaning that you've got 100 grand in income, then you add another $28,000 on top. Your tax rate is probably, call it, I think it's like 30 cents to a dollar. Then you're going to be borrowing less. Whereas if negative gearing turns on, that's basically when negative gearing turns on or is on, it basically calculates it very differently, because they understand that you get a tax offset or a tax refund at the end of the financial year. So that's basically the difference, right? It's huge, right? And I see why the government's doing that, because again, the investors have an upper hand with negative gearing because they can borrow more. And in the example, it's 240 grand. Now they're kind of leveling it.
So how would the next generation buy? I mean, if they can't even, if their capacity is much lower than what they could have before, what's available in the market? What can they even buy?
Yeah, well, it's kind of on the demand side. They're trying to target the demand side from investors because they can't borrow as much. They might not be able to bid as high. That means the owner occupiers have a better chance. I don't know if it's actually better, but at least we're not talking about 240 grand difference in borrowing capacity, for example, what I've shared before. So it's just, it's kind of leveling the playing field to a certain extent.
Yeah. So does that mean that they would need to have a different structure or Like, yeah, this sounds like something that's a lot more to unpack.
Yeah, there's a lot, right? Like for me personally, like I was reinvesting.
Yep.
I started living at home and then just buying investment property. But the beauty was I could go use proposed rent that I could get from the property as well as negative gearing. And that allowed me to buy a better quality asset. Now, that benefit is no longer applicable for, young generations now. If you are thinking about entering the property market and buying it as an investment property.
Yep.
Right? So you've lost that benefit, which is not good.
Yeah.
Right? Now it's like, is it better to buy it as my place to live or still buy it as an investment property?
Yeah.
That is yet to be determined.
Yeah, it just sounds like it's a lot harder now for anyone wanting to get into the property investing game. Like, just to start, there's just so much that the government is like making it just so much harder for everyone. I mean, maybe that's why they definitely need to come and speak to you to really find out what their borrowing capacity is, what are the mistakes that they need to look out for, depending on the situation and whatever stage they're at as well. So, before we close, is there where should people go if they want to find out more about you and if they also want to, explore working with you as well?
Yeah, awesome. So you can go to our website, Finer Advisory. It's basically Finer without the E, so FINR advisory.com.au. Or if you want to watch my content or find out a little bit more about myself and get access to property and finance tips, then you can search me up on Instagram, and the handle is simontran.finance. But also, I can give you my details to yourself, Keith, and you can put it on the podcast.
Definitely, yeah. We'll definitely put that in the captions or the comments. So for anyone listening, you can definitely go and check it out. And so, yeah, thank you so much, Simon. It's been great learning all about different mortgage structures and mistakes, especially coming out of the budget just 2 days ago. It's really relevant, and I learned so much, and I think we want to try and bring you back as well. So yeah, thank you so much for coming.
Yeah, no, I appreciate it. And just one other thing I just want to touch on is that make sure you have the right team with you that understands all these changes, because it's a different world we're playing in at the moment in the property investment game. Yeah. So thank you for having me, mate.
Awesome. Thank you, Simon. Appreciate it.